hardest things that happen during a divorce is figuring out who gets the house. Can I afford it? Can we stay here? Does this make sense? What's involved in that biggest request? Because everyone, what's the first thing they want is they want to stay in the house and keep the kids in the same school. And yet there are a lot of factors that most people don't really understand that need to be taken care of during the divorce process rather than afterwards. So my guest today is Adam Coleman, and he is a CLDP, Certified Divorce Professional Lending Expert. I'll just say it that way, and we'll get the letters later. And he's going to talk about exactly what we need to know and why it's so important that, even if you think, oh, I can afford the payments, no problem. There's a lot more to it than that. My name is Tracy Malone. I am a divorce coach, and I work all over the world. I also wrote the book on the shelf called Divorcing Your Narcissist. You can't make this shit up. So we are going to get through this question and help you, guide you. If you like this video, please subscribe, please hit like, and let's go visit and meet Adam and hear what he's got to share with us, because I know his expertise is going to give you some aha moments and maybe help you prep so that there's less surprises later. So let's go meet Adam. Hi, Adams. Thank you so much for joining me.
Yeah, thanks for having me.
I am so excited to have you talk to all of my people today. But before we start, can you just give me a little background about who you are, where you are, what you do, and then we'll hit the topic and let everyone go from there.
Yeah, I appreciate you having me on. So again, I'm Adam Coleman. I'm a certified divorce lending professional, or CDLP for short, is kind of what is traditionally known in the industry. So basically, I'm a traditional mortgage lender with a specialty in divorce mortgage planning. So I go through and help divorcing spouses go through their process, try to give them more informed decisions on home equity options or home buying options if they're going through a divorce. So that's the primary focus of kind of what I do as a CDLP at this point. So I'm licensed all over the country, I think 18 different states. So I'm located here in Charlotte, North Carolina, but really licensed all over the country. So I know we'll go through a lot more specifics on what a CDLP does, but that's kind of the long and short of it, I guess.
Yeah, well, thank you for that, because again, you're the best introducer of yourself, because if I'm like, and here's his credentials, it's boring. So it's good to have it come out of
Right.
your mouth, and it's not fake to be reading that bio. So you were talking about the divorce professionals. What's the difference between you and a non-divorce professional mortgage broker? Why should someone, or why does someone need your help during divorce versus getting just, their friend or their cousin is a mortgage broker? What's the difference? How do you help them? What's the difference?
Yeah, no, it's a good question. So, and I was a traditional mortgage lender for many years until I started adding this into the repertoire. But basically, a traditional mortgage lender, whether they're a loan officer, broker, banker, there's like a million different names for us out there. Mostly are there to just facilitate a mortgage transaction. So they're there for either a home purchase or refinance. Simple as that. For the majority of the time, it's mostly product sales type of role with a fairly limited engagement period. It basically typically begins with the house search and ends with the closing. There's not a whole lot more to it beyond that for most mortgage lenders. It's just not the nature of the industry. It is very much a sales type of role for most companies. And that's from top down. I mean, that's really what most companies want the people to do, is it's a numbers game, unfortunately. And that doesn't necessarily translate into the greatest of service, especially with kind of a nuanced thing like a divorce situation, as you know more than anybody, of kind of the stresses and the differences that go along with a divorce that are just not typical as you would see with just a traditional person buying a house. It's just a totally different mindset. So in a divorce case, traditional mortgage lender would typically tell the divorcing spouse that there's really nothing that they can do on the mortgage until the divorce is finalized. And so tell the divorcing spouse to reach out back after the lender's done, after the divorce settlement agreement's in place, and then only then they can really do anything with the process. So there's really not a lot. It's kind of kicking the can down the road, waiting for something to be done before a traditional mortgage lender would really get involved. And truth be told, for years, I was kind of the same way, and everybody was, just because there wasn't really that interaction as much with the divorce team. And we'll go through this obviously in more detail, but that was really what sparked my interest in it, is because I knew that there had to be a better way. It was so frustrating to deal with, like, a divorcing client, go through that whole process, this whole stressful divorce, come to me afterwards and go, all right, I'm ready to buy this house, or I'm ready to keep my house, ready to refinance. And we find out there's so many issues along the way that really needed to be addressed ahead of time. So that's what kind of sparked this certification and the Divorce Lending Association, which really oversees all of us as CDLPs. So that's where we kind of got involved. Is there needed to be a complete change and shift of how mortgage lenders dealt with divorce cases, and it just wasn't happening in a traditional sense. So, again, so many nuances with divorce. It impacts mortgage lending in a lot of different ways. So that early planning and coordination to avoid a lot of those issues was really key. So then my role, and really all the certified divorce lending professionals, there's a bunch of us out there, but basically we do all the same things that a traditional mortgage lender does in terms of handling the mortgage start to finish. We go through, do the same transactions. It's the same products at the end of the day. And really, from the mortgage piece, from start to finish, that part's equivalent. There's no changes, there's no different fees involved, there's nothing that's unique about that piece of it. A lot of it is that pre-planning stage. So we all get involved much, much earlier in the process and then become part of that client's divorce team, along with the attorney, mediator, you as a divorce coach, financial advisor, if there is one, and other divorce specialists along the way. But basically, we're part of that team. I would typically say that we're kind of part of the financial team with the financial advisor. That's kind of my role into this.
Mhm.
But long and short is we help the client understand really what their options are, whether it's keeping the existing home, possibly buying a new home, possibly neither. And maybe we find out that renting is actually a better option, but we uncover all these potential obstacles along the way so that the divorce team and the attorneys can really strategize ways to accomplish the goals of the divorcing spouse that are actually realistic, and that we're not fighting for something that ultimately can't happen in the real world. Because that's really the big reason why I got involved, is I was seeing all these things, that small tweaks or like little things that could be done with a divorce settlement agreement, that if we had known about it 6 months earlier or a year earlier, we could have tweaked those things and they would have had no issues. But then something happens where it just doesn't happen correctly, and then we're having to be the ones to tell them, you went through this whole stressful divorce process for years potentially. You think you're getting an easy situation where the divorce agrees that you're going to keep the house, and then I have to be the one to tell you this isn't going to work because of some strange nuance with the settlement agreement and really odd rules and mortgage underwriting guidelines. So that's kind of our role, is to avoid that whole hassle and get involved early and really address those things head on, when we can actually make that change. So
Thank you. That's again, people need to understand this because it's your early involvement that is going to
right.
change the fact that they can keep their house, they can buy their ex out. A lot of people in the divorce, they're focused on not what they're going to get in the settlement. So, I'll be entitled to half of the retirement and I'll get half of whatever, blah, blah, blah. So I'll be okay. I can afford it. But there's a
Right.
lot of factors that are going to come into this, and positioning those assets or income in different ways is going to help them versus, oh, we just, signed on the dotted line and, this is now written in stone and it doesn't look as good on the paper on the divorce decree as you could have made it to be able to qualify for the mortgage and the refinance.
Right. Well, one thing we say is what's legally permissible is not exactly the same as what's allowed on the mortgage side. Those two things don't always communicate very well. And it can be somewhat arbitrary, but it's kind of translating those things and really connecting the dots is really where we kind of see our value come into play quite a bit. So.
And when these people reach out to you and someone comes to you, what is their biggest thing? Like, what is their biggest like reason for reaching out, or like, hey, help me, or what do I do now? What do you think is the biggest thing that people need to know? If they're struggling with this, this is how, and this is what would happen.
The biggest thing without a doubt is really, can I keep the house? Like that's the number one question that I get really all the time is, we kind of have this common scenario where we run into it really every single scenario almost, is whether it's some kind of emotional connection to the home, or maybe it's a sense of community or continuity or safety, whatever the case may be. There's this underlying drive to kind of keep the house, and some of it is thought of maybe in more of a logical term of they think it's going to be the cheapest option or just the most convenient option. So they're just really focused on, what do I need to do to keep it? What are the pitfalls that need to happen so that I can actually do this? Help me get that taking place. And it's very rare that every once in a while somebody will come in with a situation of like, all right, I don't want to keep the house, I just want to sell it and be done with it, and I want to move on, I want to start fresh somewhere else. And ultimately that's a different conversation to have. But really, a lot of times, if it's that emotional connection to keep in the house, first step is to figure out if that's even feasible. I mean, really, I think so many people assume that it's going to be a much easier process to just keep the home. And I think, unfortunately, a lot of people think there it's just a simple process of keeping the same mortgage, really just kind of removing some people or removing the ex-spouse from the title and from the mortgage, and then just move on. And they kind of just keep going with what they are used to paying on the mortgage, and there's really no issues going forward. But that's the big issue, is that 9 times out of 10, that's not going to really work. So they're going to have problems where you either are forced to refinance, you're forced to pull money out to pay like an ex-spouse for some of the equity share. There's tons of different things that are going to impact you to where you're in a new normal situation where whatever you were paying before is very likely not going to be your situation going forward. And we need to figure out, is there a feasible way of accomplishing what you're doing? Because again, if that's the goal and it's doable in your budget, we're going to do everything we can to try to structure it in the best possible way so that you can keep that house. And in some cases, that's by far the best option, but it's not as easy as a lot of people think it's going to be. So figuring out if that's possible is kind of the step one to kind of answer that question of like, can I keep this house? Basically, there's three main things that we go through. It's like, all right, we look at options to keep the existing mortgage in place if possible. No changes, great, keep your low interest rate, perfect scenario if we can do that. Unfortunately, most people don't have mortgages where it's just in the spouse's name that's keeping the house. So
Mm.
that becomes an issue where, all right, how do I get my ex-spouse off this mortgage? How do I get them off title? We go through all those things to see if that's going to cause any problems. The other option would be, all right, what is this going to look like if we refinance and just simply remove your ex-spouse from the mortgage and title? What does that look like? And does it fit in with, one, what you qualify for? Because that's a different scenario than what you can afford. And then we try to, adjust those two things to figure out if it's going to work for their situation and really do that analysis. But then the third option would be to refinance and then pull money out to pay off the ex-spouse, to figure out, all right, how is this going to look? Because now we're taking a whole new interest rate, new loan amount. Your new normal payment is suddenly going to be a whole lot different. What is this going to look like? Then once we have a better idea of the numbers involved, I really like to reframe the conversation a little bit and then just have the client think, all right, if you were shopping for a house, for square one, you're kind of going back to, I'm just looking for a home. Is your current house the one that you would actually buy? Like, if all things, if you just redo everything and it's on the market now to buy, would you rebuy that at the current market price that you're in? Because that's essentially what you're doing with almost all of these scenarios. And I don't think a lot of people really get to that conclusion right off, because most people are like, oh, I don't know. Like, honestly, thinking about it that way, I don't know if that's really the house that I would want to be in. Like, there's all sorts of issues with it. I've got some inspection issues to deal with. The roof is getting old. The HVAC is not really working. And then I have to tell them, all right, here's your new payment for that house if you were buying it today or refinancing it today. And that gets thrown into the whole mix to try to figure out if that's even feasible for their budget as well. So that's always the biggest question, I think. So, I mean,
Mm.
just looking at it essentially as like rebuying the house and seeing what that would look like from scratch. Yeah, I think that's a big eye opener for some people. And then I guess related to that, the big question would be, if you do keep the house, there's other tax considerations involved that a lot of people don't realize. So we go through and kind of explain, all right, the last thing I want somebody to do is keep the house because of an emotional decision, and then 6 months later or a year later go, I can't afford this, or this was a bad idea. I really need to actually get rid of this house. And that I see that way too often. And it creates so many issues financially that people just don't even realize, because there's tax complications, there's closing cost issues that you have to deal with that I don't think most people, even attorneys, don't really address at all. Where you could suddenly keep the house, and if it's not part of the divorce that you're selling it, suddenly you go from potentially getting a $250,000 tax exemption all the way down to nothing. You suddenly have to pay a massive amount of capital gains in some cases, or realtor fees is another one that people just don't even think about when they're doing that. So many different things that pop up, and it all stems from that one emotional question of, can I keep this house, and what can I do to do it? And it's just a lot of reframing that to figure out, is that really the main driving factor, or are there other things going into it that, there are other options that might need to be considered along the way as well. So
And what you're just saying about the indecision, they go for it, that you get them approved, and 6 months later they're like, oh my God, I can't afford it. That, I always warn and refer them to people like yourself, but I'm always like, if you sell it 6 months later, you're eating that entire realtor cost, you're eating all of those fees and things, and could have tax differences as well, other than splitting it and selling it while you're, have a spouse. They're taking half of that load of the fees that you would be paying. So there's advantages to understanding, hey, again, you do that and you're doing it 6 months later, you're going to be on the hook. You're going to lose even more, 3, 5, 10%, whatever. I don't think it's 10%, but whatever
oh
the
yeah.
realtor fees are, it could be substantial based on the price of the house. You could be losing a lot of money if you don't do it and understand the situation the first time.
Right. Yeah. And that's the last thing you want to see is, if you're going into this and you want to keep the house, great, but make sure it's long term. I mean, it's almost like somebody that's trying to buy a house from start. I don't want to help somebody buy a house just to know that they're going to sell it in 6 months. Financially, that's a horrible decision for most people to make. And this is the
Mhm.
same way, but this is even worse just because you could have probably structure this in such a better way to avoid so many of these issues, or at least shared them with your ex-spouse so that they're also on the hook for some of these expenses that, I mean, they share the house with you. You might as well share in the expenses of selling it if you're going to sell it. Don't wait 6 months and then you be on the hook for everything, and you didn't get anything out of it at that point. So definitely a big one to avoid, hopefully.
Absolutely. And so, what are some of the real kinds of things that people can do in divorce negotiations to improve their chances of getting this and avoiding some of this problem stuff?
I would say the big one that we get involved with, and there's a lot of little ones, but the big one is qualified income. So, and that's really the big unknown that, divorce attorneys and financial planners, they have a different way of thinking about your income going forward versus a mortgage lender. So the big misconception is like, all right, how much income am I going to have? What is my budget going to look like? And then to really connect the dots to what a mortgage lender is going to actually consider as income as well are two totally different things. So for a mortgage lender, qualified income, they're very arbitrary guidelines when it comes to what qualified income is. The big ones, obviously, great. If you have a W-2 full-time job, perfect. If you make a lot of money, you're going to easily qualify. Great. That's an easy process if you have a full-time job. But that's not the normal situation that I'm getting involved in. It's a lot of times maybe one person is staying at home and they're the ones keeping the house. They might not have had any sort of regular income to use. So their mindset is, all right, if I'm getting alimony or child support, I should just be able to use those to qualify. It's about the same, looking at those numbers, I can qualify for the mortgage payment based on these. And it's logical thinking of going into that. But unfortunately, mortgage lending is not always logical. It's very, again, very arbitrary and not the most logical thing in the world, where I can't use alimony and child support just because it's there. It has to meet certain guidelines. And most people don't really fully understand the guidelines, especially when they're setting up a divorce decree, because that's the last thing people are thinking about when they're going through these negotiations. Is like, oh, I need 6 months of this, and I need it to continue for 36 months after. None of that usually comes up. It's usually, what's customary, how much can I get possibly, and then we're left kind of holding the bag at the end, hoping that, all right, was that enough to actually do what we're trying to do. The main thing with the income is that it has to be received for 6 months for and on time. It also has to be built into some sort of written document, essentially, like either the settlement agreement or some sort of temporary orders. But I'm getting that a lot in like a real world situation. Is I'm talking to them ahead of time. They're telling me, all right, we think we'll get X amount of dollars for alimony and child support. What can I qualify based on that? So then it's a matter of, all right, well, first you need to start getting this in place so that you can start receiving this, because I can't use it until it's been in place for 6 months. So the sooner we can get that clock ticking, the better. But then the other big one is it has to continue for 3 more years after the loan is closed. Not the divorce is finalized, but it's based on the loan. So we run into that a lot, where the attorneys may have it set up for maybe 3 years total, but that doesn't give us enough time for the 6 months and then the 3 years afterwards. So then we're stuck. Like literally, this person could be making $10,000 a month in alimony and $5,000 a month in child support. They think they're in great shape, but we actually have $0 to use for qualifying purposes. So then they can't qualify for anything. I mean, even if they waited, if they don't have that 3 year continuance, they're stuck. There's just no other options out there. So kind of having those real world talks of, all right, can we just tweak this? Like, and I'll talk to the attorneys, I'll talk to the financial planners of going, all right, we understand the general concept of what you're trying to do. Can we get this maybe adjusted slightly? Like, may not even be a big requirement. We just need like 6 more months of alimony or child support. Child support's different just because it's based on the age of the children. But that's another thing that people don't realize. They're like, well, I'm getting $5,000 a month in child support, but your two kids are 16 and 17. That's not going to continue for 3 years. So that becomes no income for our purposes. And truth of the matter, it's not very long-term income for them either. So from a budgeting standpoint, that's another conversation to have that I don't think people realize. They just see the dollar figure of, all right, this is what I'm going to be getting for a month, every month for the next couple of years. I'll be fine to kind of, progress a little bit on this, and I'm fine keeping the house, but it's not long lasting. So we need to figure out a long-term play there. But the income is the biggest one in terms of real world. I would say some other more minor ones would be division of debts. So like some debts are not created equal by any means, and it's not based on the balance necessarily. So, a $50,000 student loan is treated completely differently than a $50,000 credit card or $50,000 car loan. Like all three of those things would have totally different effects on somebody's ability to qualify for a mortgage. And I don't think people think that. They're just like, I just want to split everything in half, and like you take the student loan, I'll take the credit card, you take the car, whatever, just to keep it simple. But usually there's ways to do it to where it's much more economical for the person trying to keep the house, or that didn't have a lot of the established full-time W-2 income already, that we can try to help those people in more ways to say, all right, let's take this debt because it'll qualify you for a higher payment because your monthly payment on that debt is so much smaller. Or maybe we can just rearrange some of these things in a much better way. Let's not split this debt because I'll still have to hit you with, part of the payment on that. There's a whole big, report that we do to basically try to minimize the amount of some of these debts so that we can easily qualify them for what they're trying to accomplish. But then those are the big ones. Obviously, income and debt are the two driving factors on a mortgage. But even little things like escrow balances or property taxes or like title vesting, like little things that we've seen pop up all the time where the attorney just doesn't think about it. It's like, all right, the title vesting is in both your names. It's going to vest to where it's not right a survivor. Now it's tenants in common. That can change things from a legal standpoint. So there's so many things that kind of get involved on the mortgage side that we can sometimes bring up to the other parties, and it just creates a lot fewer issues down the road. I would say those are the primary, like, major real world scenarios, but there's tons of different, like, minor things, because as you know, every divorce is different. I mean, they're just not, no two of them are ever alike, so you kind of have to adapt and kind of roll with the punches on some of that stuff.
Yeah, I have a client that to kind of hurdle what you're talking about with the 6 months and the money coming in, if you didn't get temporary support, does temporary support count towards that? So if they're looking for 6 months, if they had that, that counts?
It does, as long as it's kind of in a written form. So I usually tell people to create the temporary orders, get it in writing, make sure, and there's some nuances to that even, where you want to make sure that it's basically like a check or a transfer directly from the person sending it to the person receiving it. I've seen situations where they try to put it into a joint account, and then the ex-spouse is pulling it from that joint account each month, and it's a mess. Like, you couldn't use it in that situation. Or a big one that I see is, we're not going to give you alimony, but I'll cover the mortgage payment instead, or I'll pay the car payment for you instead. Things like that, where that's not usable. Like, it doesn't do us any good at all. If you could be paying a $5,000 mortgage payment for the spouse that we're trying to get credit for, in terms of alimony, that's not the same. So it basically has to be a check, or, direct transfer from one ex-spouse to the other ex-spouse in a very clear delineated form that we can obviously show, and then we can use it. So temporary orders are definitely usable. So the earlier they can start, the better. And that's a conversation that comes up all the time.
Because it's on paper then, right? That's the whole
Yeah,
concept. It's how the clock is ticking, right? I have
right.
had someone, as I just remembered, was that she didn't have it. Like, there was no temporary support, but once the decree was signed, she was going to start to get X amount of money. And so
Mhm.
what they decided, and again, this happens to happen in, cooperative, more cooperative than a narcissist divorce,
Right.
is we'll keep the house because the kids are in it. We'll keep the house in our joint names for a year or 7 months or whatever it is. So now you're getting the payments. We haven't rolled over. It's still in, it's still in both of your names. And so therefore that allowed the buying of time for her to have that now record of getting the money. And then at that point, we'll switch it all over. So is that a common thing for
Right.
people to do? Or is that more unusual that they agree to doing something like that?
I'm seeing a lot of creative ways. One, because they're so determined to keep the existing mortgage in place, I think, because they see rates are obviously lower back then when they had it versus what the current rates are. So I feel like they're doing some unusual things, especially in this market versus in previous markets where it was probably a simpler decision. But that certainly happens quite a bit. I've seen people stay on the house for, upwards of a year or two, and that creates some issues just from the tax planning standpoint that people don't realize, and especially from a liability, where you do kind of want that clean break. Like, I couldn't imagine going through that situation and just having both people on the mortgage, especially when only one person is essentially responsible for it and living in the house.
Mhm.
Obviously, if they're both living in the house, I have seen that before as well. That's a whole different story. I'm not sure how that works realistically for some people. I guess if it's super amicable, then I could see that. I don't, that's not your typical client base probably. So it's probably not something that you're having to come across all that often. But people are definitely getting more creative, to just try to find a way around it. But I think ultimately it might shoot them in the foot, just because there's so many other small, tax considerations that come into play if you try to do that and then don't build it into the divorce. There's some major red flags that might pop up down the road for them that they might just not be thinking about. And there's just so much that could happen in that time period as well. It's hard to really kick that down the road for a year or two and not have that clean break. It's kind of hard to think about that being realistic for most people, but people are doing desperate things at this stage. So,
Well, the rates are so much higher than they were, and so
right.
they've got to get a little bit more creative especially if they want to hold on to that house. And, you know, almost every client I come in is like, how do I keep the house? Male or female, doesn't matter. It's
Oh,
like,
right.
it's a thing. And so, you know, this is a huge obstacle. And all of the different things that you've explained to us today are going to shed some light for people to really say, you know, even if we've agreed, like we just talked about, we agree that the house will stay in both our names for 1 year. Um, you still need to know what's going to happen after that, and what could I have done to still qualify besides get my alimony and stuff like that, to do this work prior to the divorce, and making that
Right.
commitment, just to know that when that commitment's over, I know what my options are. I've got a plan. I'll qualify because of A, B, and C. I've got all my ducks in a row, and that way the transition a year later is a simple one. And again, maybe you'll have a different mortgage rate, but at the same time, you're not going, what do you mean I can't afford it? You know, like you're sitting here,
Right.
and that's not the time you want to be, you know, blinded by the light and going, what do you mean? I don't understand. This was the plan. It's not a plan until they've talked to someone like yourself that can really go, when this happens, this is what we're going to do. And you will qualify because of ABC. We've done everything we need to, and they'll feel so much more secure in knowing that at the end of that trial period, if you would call it that, then we will go and I'll get the mortgage and this will be this, and I'll buy them out that way. You have all of those ducks lined up so that you're not surprised, and you don't have
Right.
to go, I can't afford this house. It's 6 months. I can't do it anymore. And everything implodes. And then you're eating all of that realtor cost and all the tax implications from selling it because you did the 6 month deal. So is there anything that we missed that you want to close with, and just tell us anything that they should know?
No, I think that covers most everything. I mean, I would say the key is just to get us involved early. And whether it's you're keeping the house, or if you know you're trying to buy a house, or even if the person's vacating the house. I mean, that we focus most of our conversation on the person trying to stay in the home, but so many of these things also impact the person vacating the home, possibly to even a bigger degree, honestly, if they're the ones paying alimony and child support. That's a whole separate conversation that those people need to really have a lot of pre-planning to get involved. So honestly, a lot of situations I like kind of being kind of helping on both sides, not necessarily neutral, but I can act as that role where so many of these things kind of go hand in hand, where it's like, all right, this person's paying alimony, but they're not going to qualify for buying a new house or refinancing an existing home, and that could impact the other spouse in some ways as well. So they really go hand in hand in a lot of cases. You can't really look at them independently in most scenarios. And it could also help the negotiations if both people are kind of on the same page. So definitely same advice for the person vacating the home. It's a conversation that needs to happen as well, whether you're receiving or paying lump sums or alimony or any kind of separate maintenance. Definitely would highly recommend getting somebody like me involved well in advance during the negotiation stage for sure.
Well, thank you so much, Adam. Before we go, I see a giant QR code on your wall with a dinosaur. I may add, there's a dinosaur. I'm sure there's a story there.
Absolutely.
Uh, and other than using a QR code on this video, how do people reach you and find out more about you? We'll put your link below and all of that, but what's the best way for people to reach out?
Yeah, it's pretty easy. It's adamcolemanmortgage.com. And then I have a whole separate tab actually on there for divorce. So if they're specific on divorce planning, it's got a lot of free resources, a lot of like, blog articles, podcasts, because I do this as well. So I've talked to a ton of different divorce professionals. So you can get a lot of information on the consumer facing side, which is nice. So definitely check that out, and check out the podcast and get more information on different divorce professionals in the field beyond CDLPs as well, like yourself, like financial analysts, because it's not just about the attorney for sure.
Yeah, wow. Thank you. This has been an amazing interview. I know that it's
Thanks for
going to
having
help
me.
a lot of people. So thank you so much.
That's my pleasure. I appreciate you having me on.
Well, I hope you guys found that helpful. He's brilliant. He's a friend of mine. I'm so happy to know Adam Coleman. And so if you guys want more information, visit his website. I'll put the link down in the notes. It's going to be on the screen, so you'll see his name right there and his URL. But just ask, get some of your questions answered. And for a mortgage broker to be licensed in 19 states, he can pretty much help people wherever they are. So let's, keep this in mind and not make any big mistakes that we're going to regret 6 months later. This is Tracy Malone. Thank you so much for joining us today, and I will see you back again.